Guys, what is up? Welcome back to another episode. It is episode number 265, if I'm not mistaken. And it is the end of September. The Ryder Cup is on at the moment. I saw some dismal scenes there today with the crowd getting kind of ugly. And it's just it's interesting to watch what's going on over in the US. Coming back here to this side of the pond, we have a guest this week, a guest from Ireland. And so my guest is Dave Quinn. He is an Irish financial planner, and he has some interesting take on the way that you should set up your business and how you should prepare yourself for your financial future and well-being. And one of the things that we get into in this podcast, which I really believe is that if when you're starting out right at the very beginning, if you're whether it's setting up a business, or I would suggest whether it's going into real estate or anything of that nature, is that when you're starting out, get good advice from experts who know what they're doing, people that you know, people that you trust, and get those guys to give you the advice on setting it up at the beginning. Those early bits of advice, the structures that you can put in place off the back of that advice, those structures can mean that you have this compounding benefit over the next couple of years as your business or as your investment portfolio grows. And it can be hugely consequential over the long term. You know, in year one, it might only be a small difference, but you accumulate those over many years and you're going to go and see a big difference. Now, this podcast I actually recorded back in July, and it was one of those situations where I recorded it just a couple of days before I went to Spain. And then, as you know, I got tied up in Spain. I ended up being down there for 5 weeks. And so this podcast, I don't think any of it's out of date, but it is from a recording I did back in July. And so one thing I will also say, it's worth listening out for or taking note of Dave's details when he reads them out at the end, is if you're into property and you're looking for property pensions advice, Dave is involved in that kind of stuff as well. And so well worth listening, well worth taking out the notebook, taking down some ideas, and I look forward to letting Dave entertain and educate you. So without further ado, my conversation with Dave Quinn. Good stuff. Dave Quinn, welcome to the podcast.
Thanks, Gavin. Delighted to be on.
So Dave, you've had the last couple of weeks, my guests have been in America, in the UK, and Dubai also. So it's nice to have somebody based in Ireland here for a conversation for a change. Why don't you just give us your 30-second elevator pitch? What is it that you do?
Yeah, so we're InvestWise Financial Planning. And as it says in the title, we are a financial planning firm. We kind of focus on giving people some sort of perspective and outlook on the direction they're heading in financially. And then once we know that direction, we help them to kind of achieve their aspirations and their goals for future life. That could be their business aspirations, retirement aspirations, what they want to do to support family. And obviously, stemming from that then is financial advice around investments, pensions, and all the rest of it, but very much focused on putting a plan in place first and trying to set some targets and some goals. That's do.
To put a roadmap in place.
Yeah.
Great stuff. Well, look, we're going to go into all of that today, but let's, as you know, I like to turn the clock back to, let's say, Dave coming out of college or school or whatever. Like, what brought you into the industry that you're in today?
Like, the short answer to that is my dad was in the industry back in the day.
Right. Yeah. Like many people, they follow their parents.
Yeah, funnily enough. But the long story is I went to DCU and did a business degree. And I specialized in the investment markets for the last 2 years of that degree. So when I came out of DCU in 1996, I immediately started working in the IFSC for what was originally Morgan Grenfell, ended up being Deutsche Bank, and now State Street, the very big operation in the IFSC now, State Street. So it was back office and middle office investment management, supporting fund managers and learning about the markets and derivatives and how the investment world works. So for the first few years, I was working on Asian equity funds because there was a big trend for Korean equities in the late 90s. And then there was a huge crash in 1998, big currency crisis, and a big famous fund called LTCM crashed, which was seen as being the guaranteed way to make money. Lots of Nobel Prize winning geniuses got it badly wrong. And then I went and worked for a while in a small startup fund administration company called Trainot, which eventually became the big JP Morgan office here in Dublin. And when they were bought out by JP Morgan, I took a career break. And this was in St. Patrick's Day 2004.
Wow.
I left there and took a career break, worked for the Irish Sailing Association for a little while because I used to do a bit of sailing around the Athens Olympics, and for about a year after that, which was an amazing bit of fun. And I actually thought that was the way my career was going to go. Working in something I was passionate about seemed like a lot of fun, but I quickly realized that working in your hobby is frustrating. But you need some separation in your life.
Big time.
I decided that pretty quickly, and I wanted to set up my own business. So I spent a bit of time. I had made great connections in that sailing community. And as I said earlier, my father worked in the insurance business. He had retired at this stage. So he had some connections, and between the jigs and the reels and some link-ups with other people, I set up InvestWise. The company was already there just as a very small entity as part of an accountancy practice, but I took it over in 2006.
Okay, so it's coming up on 20 years now at this
20
time.
years next year. So I'd done 10 years of, building knowledge, I guess, and learning about the world, and then set this up. And and it's been going great ever since. We've been growing steadily, and we're a team of 10 now, and we have an office here in Fitzwilliam Square in Dublin and down in Cork. And so I brought some of that investment management knowledge from the first 10 years into the business. And then since then, I've been growing and learning with my clients as they've been growing. So a lot of my clients will be my age or younger. I'm 51. A lot of our clients are kind of business owners in their 40s.
Yeah.
And they try and leverage my knowledge to get a head start on what they're doing themselves with their businesses mostly.
Interesting. And let's jump into just some question that bounces straight into my mind is like, based on the clients that you've had now for nearly 20 years, like, have you seen patterns as who are the ones that are doing better today for the decisions they made way back 20 years ago?
Yeah, it's a great question. And I think I would say this because I'm an advisor, but I think if when you set up your own business and you start out, the more advice you can take from people you respect and, people who you trust early on, you can put structures in place that set you up very well later on. And the compounding effect of those structures early on can be exponentially beneficial to you, whether that's holding companies or how you structure your shareholding in your company, or what you start doing with, your reserves early on in businesses. People don't have a lot of reserves, but as business grows and succeeds, what are you doing with those reserves has a big impact later on in terms of your own financial security, tax payments, and everything else. So the first thing I would do is get really good people on board, whether that's a really good chairman or non-exec director who's working with you, or external advice from accountants and financial advisors. Like, the key with the financial advice game is to pay for the advice and not get it for free. And if you do that and you trust the people who are advising you, you can skip 5 or 6, 10 years of mistakes and learning, because we've all been through it. I'm a business owner myself. I've made the same mistakes and I've seen it over time, So if you can get someone who allow you to fast forward and skip those, that gets you set up 10 years earlier than a lot of business advisors or business owners who don't take advice.
Yeah.
A lot of us, because anybody who's setting up a business tends to be an alpha personality, and we believe in our own vision and our own path, and we try and control it. It's the same in the investment world, that we want to control everything and we want to have a say in all the decisions, and sometimes that can slow down your growth and development.
One thing that I've actually found myself giving advice to some of my own mentoring clients and stuff is that if you're a good entrepreneur and a good business person, that does not necessarily make you a good investor.
No.
And people seem to think that I was able to make all this money from my business skills, so who better to go and invest it than me, because I've got the skills. But that's, I think, a big mistake. I think people don't realize that having the entrepreneurial gift does not transfer into, because you're far more, I think a lot of investor or a lot of entrepreneurs, they're very quick at jumping into an opportunity and all that. But as an investor, that's actually dangerous, because you jump into things that your mind might tell you looks like a great opportunity today, but tomorrow it could be a disaster.
Yeah, and it's something I say to my entrepreneurial clients a lot is the best investment you can probably make is back into your own business. Firstly, you're probably likely to make a better return than the markets, or you'll fail, but you'll learn such important lessons that it'll be valuable anyway. But after that, then the big problem with investing our personal wealth outside a company is our own emotions and our own ties. We're very emotionally connected to the money, but also very emotionally connected to the decisions we've made. So we have a lot of biases around, something we've bought and admitting we were wrong. It's very difficult for a successful entrepreneur to admit they were wrong and sell their losers and hold on to their winners.
Especially if they're alpha.
Yeah.
Like that just goes against the grain. It's like, no, I'll prove you wrong that I got it right.
Yeah.
Like 20 years later, they're still holding the asset.
Oh, absolutely. And I see it a lot where someone has bought an asset, whether it's a property or a stock or something, and they bought it for €10 and it's down at 5, and they say, as soon as it gets back to 10, I'll sell, which is an irrational benchmark to have. It doesn't mean anything, but that's really common. And that's one of about 20 different biases that we would see every day.
Yeah, the sunk cost fallacy, and there's all of these different ones. I remember hearing that one before, and it's funny. It's a question that it's an example that I use with my students. Is if you bought two properties for 100k each, and one went to 2k and one fell to 50k, and you needed to sell one, which one would you sell? And everyone will automatically say, I'll take the 100 grand profit. And I say no, because it's doing well. You keep that one. The one that fell and has been a disaster, that's the one you sell.
And the other incredibly common bias, which is something similar to that we're seeing in Dublin a lot at the moment, is people holding their employer stock. And so we've Google or Workday or LinkedIn employees holding all of their net worth in their company stock. And I just asked them a very simple question. If you weren't working for Google, would you put all of your €300,000 of net worth into Google stock? And of course they would say, no, definitely wouldn't do that. But then the rationale is, well, you should sell. You should sell then.
Yeah. Or at least offload some of it,
Yeah, very common.
So what would you say are some of the mistakes that you've seen commonly made by the people that you're working with that, it's easy to see now looking back, but at the time it seemed like a good investment?
People trying to time the market.
Yeah, that's big one.
That's the number one. And I get it. It's really clear, really understandable temptation to want to time the market and say property or stocks or something looks overvalued right now. I'll wait until the crash and then I'll buy. But, 1 in 100 gets that timing right consistently. The active investment management industry doesn't do very well relative to the market. And that's because they're professionals. So the amateurs like us, in reality can't do it. And so that's the number one mistake I see people make is waiting in cash for the markets to fall. Markets, doesn't matter what the asset class is, markets tend to typically go up 75% of the time and they fall 25% of the time. But the 75% period never gets any headlines, and the 25% is on the front page of the newspapers.
Yeah.
People think the markets fall all the time, and they just don't. They average upwards. You'll see that with your portfolios. I see with mine that if you have patience and you stop trying to time the market, you'll tend to do fine over the long term. But it's really hard for us to give up that control.
Yeah.
I do have clients who have been amazingly successful traders, but they're doing 60, 70, 80 hours a week of trading and investing. They're professionals.
Yeah.
And they find it really hard, and they're very disciplined. It's virtually impossible for the man on the street to run a business or have a full-time job and accurately invest. So that's the biggest lesson. The other fundamental lesson I always say to people is it's different with property, I guess, but definitely with pension funds which are investable savings, paying too much in fees destroys any potential gains. And in Ireland, unfortunately, we haven't evolved enough that our fees are still very high on investment and pension products. So that can erode, half your gains very quickly. So we're very trusting in Ireland, and we just kind of get the advice from our local broker or local bank manager, and we think that that's the right advice. And we end up paying so much in fees that the good decisions are heavily eroded.
That's interesting. Well, can you break that down for us in terms of like what you're giving away in terms of fees and stuff?
Yeah. So if we start with the benchmark investment manager, which is Vanguard are an absolutely gigantic monster of a US fund manager, but they're not for profit.
Okay.
They're like a huge credit union with something in the region of $9 trillion under management. So they're a big monster and they influence everything in the world, really. They charge about 0.05% for their investment funds. They're virtually free.
Yeah.
That's a minuscule fee. 0.05. The typical Irish insurance fund done through a broker is about 1.5%.
Okay. Wow. So
0.05 versus 1.5%. So it's just a tiny fraction.
Yeah. Yeah.
It all sounds very small. 1.5% doesn't sound like a lot until you realize you can get it for next to nothing. And if you're in a kind of medium risk fund, you're only getting 4 to 5% a year. So it's a quarter, 33% of your gain gone.
Gotcha. Yeah. So when you put it in that context, yeah, if you're averaging 4 or 5%, that is like a substantial chunk of and every year that's deducted from your gains. So you're not getting the compounding effect.
Yeah. 75% of that is going to the advisor as commission.
5%, wow.
Yeah, it depends, but more or less, you can get really good investment products now for 0.3, 0.2% in total in Ireland. But I like to say to people, as I said at the start of our conversation, Gavin, get good advice from people you can trust. Split out where you're getting your advice from the actual work you're putting in place, and then you can be really smart about things and very clever. And that's, then you can trust what you're getting.
Yeah, if there's nobody getting a commission, then obviously that there's no axe to grind or no agenda that's behind.
Yeah.
Interesting. And so, Dave, tell us what would be somebody that's a young man starting his career that's kind of in their early 20s. The advice is always, start your pension nice and early, but it's very boring for a lot of young people to be thinking about that. So what advice would you give to a young person starting out?
So I wouldn't necessarily write off the idea of starting a pension. That is, if you have savings, it's not a bad way to start. If even starting just a tiny bit, it really does help. By the time you get to 40, those little 25 quid a month, 50 quid a month you've been doing in your early 20s, they'll have grown to probably grow by the amount you're contributing by the time over a 20-year period. So I wouldn't necessarily write off making small contributions. I would strongly urge any 20-something-year-old. If I was 23 again and I was talking to myself, I know you might ask me this later on, but invest in your education. And that isn't necessarily just doing a degree or doing a master's or a PhD. That might be an apprenticeship. It might be working for a mentor that you really believe in and admire, and spending some time working with someone that you can learn from. Education in business, education in your skill set is the best investment you can make at that age, I think. And if you have a passion for something, give it a go and try and set up a business yourself. You learn so much from setting up a business that you never learn in college. And in Ireland, the system is skewed significantly towards business owners. The best way to generate wealth in Ireland is by owning your own business and growing a business. Whatever it is, whether it's selling coffee, giving financial advice, investing in property, whatever it is, if you're a company director, you have all of the advantages that are in the system. Give it a go. And if it doesn't work out, at least you can say you've tried it. It takes a bit of bravery, but I'd guarantee you it's harder to do in your late 30s when you have kids and a mortgage. And it's a lot easier to do in your early 20s. If you have some vision, try it out. So that's the advice. You'll learn more setting up a business than you will doing any master's, MBA or PhD.
Yeah, I'd agree with that. And as well as that, I think there's an old saying that I've come across a few times about, doing an internship or working with somebody like a mentor. You said, you can learn or you can earn, but you generally don't do one or the other. So if you're working for a mentor, the likelihood is you're going to be working as an intern or something. You're not going to earn anything, but you're going to learn so much that it'll leapfrog you ahead of the guy that's earning instead.
It's a free MBA.
Yeah. So true.
Yeah. And also in that, if you can manage it and do it in a smaller business where you get access to a lot of the various activities, like the interns and trainees in the big four accountancy firms, they end up just doing a very focused audit or a very focused piece of work for one industry. And they don't necessarily, they have a nice tick box on their CV, but they don't necessarily learn a huge amount. If you can get into a small business.
Yeah.
Oh, totally. Yeah.
Yeah, you go, and it's the very same with the big estate agents as well. I know people, they say, young men tend to write to me a lot saying, Gavin, can you give me some advice? You know what, I want to get into property. Should I join, one of the big names? And I tend to say no, because if you go down that road, you'll end up holding the measuring tape or something like that. You know what I mean? You'll be doing valuations. And the thing is, you need a broader sort of, and you won't get that from the big firm. If you go into a small auctioneer's office, you might actually get a little bit of everything there. It mightn't be as glamorous, but you'll most definitely move forward in terms of your knowledge and your skills, and you get to see how to run a business as well.
Couldn't agree more. Yeah, so valuable.
Yeah. And when we were starting the call, Dave, you mentioned that behavioral, management and all that kind of stuff, that's a big part of your interest in this. Tell us a little bit more about that.
So I have to fight this every day myself. We all have biases. Some of them are very conscious, some of them are subconscious. And I would strongly recommend, if people are interested in this, if they go online and they read. There's so much material online and on YouTube around behavioral psychology, and Daniel Kahneman, Amos Tversky, and all these guys have brilliant content identifying where we get in our own way, and these rules of thumb that help us to make really good decisions. This is you'll see it in property as much as you'll see it anywhere else. It's very common in the stock market as well, where we'll have a bias for buying what we know. People who work in property will nearly always invest in property because they know it.
Yeah.
And they won't diversify, even though maybe their career is reliant on the Irish property market, and all their investments are as well. So they're all in. I see exactly the same with the tech employees, that they're in tech, so they'll invest in tech stocks.
Yeah.
And that's a really hard one to avoid, because that familiarity bias is very powerful. And we mentioned it already, another really common one is holding a stock or holding a property until we break even. That break even bias is very common. And we try and break that one down a lot of the time by saying, well, would you buy it now at this price? And if the answer is no to that question ever, then we would generally say sell it.
Yeah.
People have to make that cold, hard assessment on their assets all the time. Should I buy it now? Yeah, and there's about 50 other biases out there that are...
I've done a few podcasts on the cognitive bias and stuff like that. And one of the biggest lessons I got, because a lot of the time, you mentioned the word alpha, and I'm a bit of an alpha, I would say. And I've got my... there was a time when I learned about CFDs, or contracts for difference, and I was like, oh wow, this is amazing. Now I can play the markets, and I put 100 grand into a CFD account, and of course you can leverage up to $1 million on that.
Yeah.
So I went and I sort of went mad buying in the market, and I turned my K into 800K in about 6 months. So I was a genius in my view, and I was like, man, I'm just going to wait till it hits $1 million, cash out, buy myself a 911 Porsche, and I'll put the rest in the bank account. Yeah. And that was the plan. Do you think it hit $1 million though? Of course not.
We got to 980 or something.
This is the thing, and the market, and what I realized is that we all have these visions of grandeur, that we have like some sort of special skill set, and a lot of the time it's completely delusional. It's just that you got lucky and you were in the right place at the right time. Don't see it as anything more than that. And what actually happened to me, I put money into my pension, and I can remember putting 100 grand into my pension, and I had a self-administered retirement trust. So it was it was in a Bank of Ireland bank account, and 100K, and I said, you know what I'm going to do? I'm going to buy 4 stocks. Of course, this was 2007 or 6 or something. I bought AIB, Bank of Ireland, and then I bought CRH and Kingspan. And I put it in there, and then I completely forgot about it. And about 15 years later, I was going through my filing cabinets and stuff, and I found this bank statement, and it reminded me that I had this pension. And I was like, oh geez, I must go and look into that. And I was thinking, well, AIB and Bank of Ireland is like a basket case, like that went to zero effectively. So I said, so I have 50 grand that I wonder what happened to that 50 grand. And the Kingspan and the CRH, I was sitting on 300,000 euro. That 50K had grown like that, but I fully recognize if I had been aware that I had that kind of gain, I would have sold it like years ago. Like you'd never would have had the discipline to stay in there.
Yeah.
To watch it grow. And it's the same with Bitcoin and all these things. Like I was aware of Bitcoin in 2011 when it was $90. And did I buy it and hold it until it's like 100,000 now? Of course not, because nobody would do that. But anyway, I think it's just understanding that our emotions drive us so much that you really need to detach yourself from the investments that you make, and work with somebody like yourselves that can actually kind of be unemotional and kind of removed from it. And it's like, look, we have a goal. Here's how we're getting you to your goal. And we're not looking at the shares fell yesterday and the shares went up today and all that kind of stuff.
Yeah. And like overconfidence and confirmation bias kind of overlap a lot. And I see them every day at the moment, especially with the way social media the algorithms work. If you've bought Bitcoin, your algorithm will be absolutely jammed full of Bitcoin confirmation. And you'll see absolutely nobody, you'll never get the Bitcoin Reddit thread, telling you to sell. So, and we'll seek that out. We'll seek out the good news and we'll dismiss anything that disagrees with our confirmation. And that used to be a dangerous bias. Now it's just so prevalent because it's so easy to get sucked into affirmation.
It's an echo chamber. It's a little bit like politically what's going on in the US, where if you support Donald Trump, there's only one television station you watch. And if you don't like him, then there's another television station that you can watch. And yet you'll never watch one or the other. It'll just be, I only want to hear the stuff that I want to hear. I don't want to hear the alternative view.
And it's really, really hard now to get an independent voice. You nearly have to go to, it's just very difficult to get it. Everything's got a bias. Everything's either biased towards trying to get more views or hits, or it's paid for. It's just getting really hard to drown out the noise and find an independent voice. Even in the Irish Times and, the kind of pillars of communication, just is not really sure anymore. And it's terribly difficult for people.
Yeah, I can imagine. I mean, the thing is there's just so many sources of information. I mean, if somebody let's say somebody came to you, Dave, and they've sold something or they've inherited something and they have €1 million sitting in the bank. What would your advice be to them with that 1 million?
Yeah, so I would say the investment part of that piece of advice would probably be about step 5. We would sit them down and have a very long conversation about their life philosophy and what they want out of the next 20, 30 years, what they want to achieve, where they want to be, who they want to help, and what they need. And we'd spend a lot of time mapping that out and and it takes a long time for people to open up about this, but try and get to the nub of what their life goal is, and we have lots of really good open what if questions there to tease that out, because that's not something we talk about when we're sitting on the couch watching Netflix with our wife or partner. That takes quite a bit of digging to find that out. So we find that information out first, and then we try and put some projections together to say, okay, what would that cost? What would that look like? What do you need to do with your career, with this money that you've got, with everything else in order to achieve that? And then at the very end, we'll say, okay, to achieve all that, you need a return of 6.5% after tax, or you need these set cash flow events over time between retirement and everything else. And then when we have that number and that timeline, then we can say, okay, you need to invest in X, Y, and Z. Whereas people, most of the time in Ireland, do it the other way around. They invest straight away. They go to their bank manager or their stockbroker and he gives them a portfolio. And then their life from then on will be dictated by how that portfolio does, rather than doing it the other way around.
Yeah.
So that would be the first thing we would say to people then, whether that's buying an investment property or selling an investment property or buying equities or investing in your pension or trying it back into your business. That's secondary to trying to decide what you want out of life. Because, and that's something I've learned a lot from clients who've been through those events and through retirement, and they look back on their own lives and say, what would they have done differently or what did they do right? And that's been the message that's come through. Have a plan. Don't let your money dictate your lifestyle. Let your lifestyle dictate how your money's invested. Whatever asset class that is, I don't care. Once you have a plan.
Yeah. I think that's a smart way to look at it, because you got to have clarity about what you're aiming for. And it's funny that you say that, because it's very much part of my own process that I take my mentoring clients through, is where do you want to be, say, 10 years from now? Because that will dictate the type of portfolio that you try to build for yourself. Whereas, you could actually be looking at, on social media, to use the example again, somebody could sort of say, oh, here's a great example of a strategy where you can make a really quick return very quick. That's all fine for that person. Maybe he has certain skills, maybe he has certain expertise, whatever it is, or a network of people that he can lean on to kind of make that happen. But for somebody who is in a completely different walk of life, that strategy is just not going to work. So it's a little bit similar like that. It's like, it's like the square peg trying to fit inside the round hole.
And the other thing I say to people is, because obviously we're in a very privileged position here, and that we see hundreds and hundreds of families' detailed financial position. There's people, we have new families coming in here every week, and we see all of their financial positions, and you would be amazed at, you have no idea from the outside how wealthy people are or not. Just because they're driving a Range Rover and live in a lovely house doesn't mean they have any money. And just because they're driving, 2001 Ford Mondeo doesn't mean they don't have 3 million in the bank. You would have absolutely no idea what kind of financial position people are in from looking at them from the outside. It's really fascinating. Our wealthiest clients, and we have some very, very wealthy clients, drive very ordinary cars, and you would have no idea that they're as wealthy as they are. And we have clients coming in here who have all the bells and whistles and trappings, private school, big house, fancy car, and nothing to show.
Yeah. Stealth wealth, I think, is what we call it. And tell us, Dave, in terms of your own view on the asset classes out there, the different, there's property, stocks and shares, you got crypto. Like, what would you, give us a kind of your stack rank on what you feel like is a good sort of diversified portfolio?
You're asking the wrong person there, Gavin, because my own assets are 100% invested in equities, a global equity portfolio. I'm 30 years in the business, and that's what I passionately believe works. But that's easy for me to say, because I've been through it all and I've seen it, and I have the discipline now to leave it alone. It's not for everyone. So it very much depends on what you feel you can live with and sit on. Property is extremely attractive in Ireland, partly because it's taxed a little bit better than investment funds, but also it's not priced every day. If your investment property was priced every day, it would be quite uncomfortable, I imagine. But it's not. It's priced. You might see a new property pop up on the property price register every 6 months or something on that road or in that apartment block. So it's less volatile, and it has a very, very nice steady stream of income, and that makes people feel very comfortable. You know this better than I do. And people like comfort. So when clients come into us, I try and assess how much they can sit on. I feel the stock market will outperform every other asset class over a long period, over pension timeframes. I think it'll probably do 9 or 10% a year compound return. If you're not paying a lot in fees and you're disciplined about dividends being reinvested and all that, and it's very low maintenance, the best thing you can do is leave it alone and not touch it at all. It's simple, but it's not easy, because it does jump around a lot, and people want to sell when markets crash, and that's really dangerous, and you can destroy your wealth in that way. Property doesn't have that behavioral.
Yeah, the emotional triggers are not there in property to the same degree.
And obviously if you leverage up property, that can boost your returns, which you won't do with equities unless you do what you did with CFDs, and that's very dangerous.
Yeah.
The leverage factor can have a big part to play, but that had its downfalls in 2008 as well. Yeah. So I don't really mind. What I want for people is to get them to set their goals and what they need, and then try and design a financial plan which will help them achieve that without them blowing it up. So if I feel they haven't got the appetite for the equity, volatility, property will play a part, but I wouldn't necessarily recommend it as the first port of call for people. That's just my view. And obviously I'm biased because I've been in that space for so long that, I believe in it.
Yeah. You were a trader.
So crypto, Or Bitcoin. Bitcoin is different to crypto, I feel. Bitcoin is established enough now that it's kind of got its own little category. The rest of crypto I dismiss personally. But Bitcoin, I worry about it, to be honest. I don't recommend it to my clients. I've spent a lot of time researching it. I have a very good friend of mine who's a good client as well, who was one of the early miners back in the day. He's a tech guy and he was mining early on and explained it all to me early on. So I do understand its evolution and I understand how it's changing. And I worry about it, to be honest. For me, I don't like to buy any asset where I'm 100% reliant on selling it to someone to make money. People say it's a store of value, but that's fine. But I don't like gold either, for the same reason that I want something productive that I can value, that's giving me an income, even if I'm reinvesting it, and that I can understand. Bitcoin and gold, if I'm buying it, the only way I can crystallize that is to sell it to someone else. So I need someone to buy it off me at a higher price than I have. And that's speculation as far as I'm concerned. You can make all the arguments in the world about fiat currency and, the demise of the dollar and all that stuff. And I do think the future is in digital currencies, but somehow I think they're going to be stable, central bank managed digital currencies. Now I'm going to get a load of hate from the Bitcoin community on this.
Of course.
But I don't mind. I'm happy to miss out on the Bitcoin gains and just stick with the best companies of the world and invest in them. I just want good returns, liquidity, and something I can understand that's income producing. And that property is income producing just as much as equities. The only difference for me really between property and equities is liquidity. If I'm 60 and I need 100 grand to support my kids buying a house, I don't have to sell the whole property. I can liquidate some equities and do that. Or if I need money for a nursing home, or if I need money to reinvest into a business, I love having access the next day.
Yeah.
I think that's the big advantage equities have over property that people don't value. And I think there's a huge value in liquidity. Now, if you have a big diversified property portfolio, then you're fine. But a lot of Irish property investors have one or two investment properties they maybe accidentally hit. So they have a liquidity risk.
Yeah, I think you're right there. It's and the thing is, it's like the banks. It's when everything is going great. It's like when it's sunny, they're giving you out the umbrellas. Like when everything's going great, they're happy to lend you the money. And as soon as there's a downturn, they want the umbrella back. It's like when the rain starts, like forget it. And that's the problem. Trying to get liquidity when you need it is when you find no, sorry, not possible. Whereas. Yeah, it's very hard to get it. Interesting. So, and like, what's your view on the market at the moment, Dave? Like, I've been watching Donald Trump with tariffs and the uncertainty, and like, I kind of worry that he is introducing an element of volatility to just the world that really it's hard to see what the future holds economically, because like we're all uncertain about tariffs, first of all, and if he goes and he lobs 30% on the EU as he's talking about, do we retaliate? Does this become another trade war and all that? But more, I'm also worried about the size of the debt in the US and the potential for the US just to collapse.
Yeah.
Like, what is your view on that? Do you have ways to kind of protect yourself against that kind of potential outcome?
So kind of three answers to that question. One is on the equity market, one is on the bond market and what you're talking about, and the third is what we should do. So I think the US equity market looks a little overvalued, and Europe and emerging markets look reasonably valued. So, if we have some control over our portfolios, we would be tilting them a little bit that way. If you just buy a world equity index fund, which is often available in people's company pensions, for example, you have over 70% invested in the US at the moment, which is the highest it's ever been. So if you have some control, tilting that down a little bit does seem to make sense. I think Europe is probably going to benefit a lot from these tariffs because it's going to make Europe leaner and more efficient and less reliant on the States.
Right.
Emerging markets looking historically incredibly cheap. No one wants to invest there, and that's why it's cheap. Often the time to do it, as they say, it's only when when the tide goes out that you know who's swimming naked. But this is the time you want to be buying assets cheap and selling high, but that feels very difficult to do. So that's my view on the market for equities. The bond market for European investors, for Irish investors, really has to be hedged to Europe. You should really just be investing in shortish dated European bonds. If you're working in a bank or in a big company and you're in a default pension investment strategy at the moment and you're in your late 50s, you're probably 70 or 80% invested in bonds, and a lot of that is long dated American bonds, and that is a very, very dangerous place to be now. because the US bond market is a mess. They've borrowed too much and they don't know how they're going to repay it. Trump is trying to bring these tariffs in to pay the interest on the debt bill.
Yeah.
That's really what he's at. And I don't think he's going to get away with it. But if he does, on the flip side, the bond market's going to make those bonds more expensive. And the US economy is going to slip a bit, which reduces the tax take. So the bond market needs careful attention. But then the third answer, I would say, I step back, take that hat off and put another hat on and say, you can't time the markets. So stop trying to be too clever. We could sell now and wait for the markets to crash and we'll buy in again. But I said that at the start of the conversation. When do we buy back in? I have a great chart that I put up at a client lunch we did earlier in the year, showing the best in the period from 2002 to 2022, the best 10 days in the market. And they were all right at the depths of the horror shows of 2008 or 2020. March 2020, there was a day in March 2020 in the middle of COVID when we were all on 2K lockdown, when the US stock market went up 10% in one day.
Wow, yeah.
If you'd watched the Big Short movie, that day that the Lehman Brothers guys were walking out of the office with their badges in their hands and the boxes, the next day the stock market went up 10%.
Yeah,
just those 2 days, that's 20% gone of your cumulative return. If you sell now, you have to buy back in before there's any good news. You probably have to buy back in when the news is at its worst. And good luck trying to do that. That's extremely difficult. So a lot of the time, I'll say, talk to your advisor, make sure your plan is on track for what you need long-term as part of your financial plan. Make little tweaks when it makes sense, like don't have long-dated US bonds in your portfolio now, if you can manage it. Other than that, leave it alone and focus on what you can control, which is your business, your family, your cash flow, your spending, and trust that capitalism isn't going to fail and that the great companies of the world are going to continue to be profitable, whoever they are, that your property is going to continue to pay a rent, and focus on what you can control and leave the rest alone, because trying to manage it is extremely frustrating and difficult.
Yeah, I just think human beings are just way too emotional to get on that roller coaster where daily price fluctuations and all that just make it impossible.
So hard.
Interesting. Dave, looking at the time, I'm thinking I'll ask you some of the final questions. First of all, if anyone wanted to reach out and work with you or inquire or anything like that, where's the best place to find you?
Investwise.ie is our website, or you can find me on LinkedIn, Dave Quinn. Feel free to reach out to me on LinkedIn or send us an email through the website. I'm always open to chatting to people. There's never any obligation for a conversation to see if we can help. We can't take everyone on, but we try and help people wherever we can. We don't, so that's the best way to reach out to me, and we can shoot the breeze for 15, 20 minutes and see if we can work together. You might get something valuable out of that anyway.
I'll put some links down below in the show notes.
Thanks.
And Dave, you alluded to this earlier, but like knowing now what you know at the age of 51, what would you say to 21-year-old Dave coming into the early stages of his career?
Take loads of risks early on. Try and find people around you that inspire you and that are exciting to work for, and put yourself in front of them, even if it does mean working for free. I don't believe in anyone ever working for free, to be honest. Any interns we ever get here in InvestWise, we always look after them financially because it's only fair. But get in front of people that inspire you and get away from jobs and people that bore you, because you're too young to be in a boring job.
Yeah.
Study and learning doesn't always have to be through a big institution. It can be just as much work oriented, even out of school, to be honest. You'll get a great MBA working for a startup for 3 or 4 years.
Yeah. And it's funny, one of the more successful clients inside of my program left school at 14. I became a tradesperson, and it's just managed to be smart enough to kind of build his portfolio up in a nice way. And
that's a great story. Yeah.
So a lot of people, they hold this, you have to go off to university and stuff like that. Not the case, and especially in this day and age with all the tools we have, like, artificial intelligence and cameras and, the ability to do social media and everything like that. It's like, it's a completely different world to the one you and I came into.
Oh, very much so. It was unheard of not to do it. But like, if I look back at my 4-year degree, I had great fun, but I'm not sure I learned a huge amount. I learned a bit.
Yeah, whatever you had to cram just the week before the exam. Yeah. Anyway, Dave, it's really nice talking to you. Wishing you all the best with your career and your business, and hopefully we'll get a couple of people who are listening here today found that useful, and we'll reach out to you.
Delighted to be on, Gavin. Thanks a million for inviting me.
Not at all.
All right, guys, I hope you enjoyed that conversation with Dave Quinn. I'm actually going to get Dave to come to one of my upcoming investor summit events that I host. And he's going to be giving a talk on various structures that you can put in place. But I think probably, given the audience that I have, I think probably property pensions would be probably a bit of advice that all of you guys would be interested in. So on the topic of my event, my Investor Summit event, which takes place every October, every February, and every June, the upcoming event is next Saturday. So as you're listening to this at the beginning, at the last week of September, Saturday the 4th, that is the date of our upcoming event. And I've had a number of new members join the program in the last week or so on the back of hearing the information about this event. And so if you would like to attend that event, and if you are interested in becoming a mentee of mine, it's a 12-month mentorship, and it includes the 3 events that we do a year plus various other things. If that's of interest, do reach out and you can come along to the event Saturday the 4th. So guys, until next week, I'll speak to you then.